Between February and November 2024, the world's wealthiest individuals sold over $50 billion in stock. Not quietly, not gradually. In massive, coordinated transactions that set off alarms across Wall Street. Jeff Bezos sold $13 billion in Amazon. Mark Zuckerberg sold over $9 billion in Meta across multiple transactions. Jamie Dimon, CEO of JP Morgan Chase, sold stock for the first time in his entire 18-year tenure as CEO. Larry Ellison unloaded $3 billion in Oracle. The Walton family dumped $2.3 billion in Walmart. And NVIDIA insiders, riding the AI boom to all-time highs, sold over $1.2 billion while telling the public the best is yet to come. This isn't portfolio rebalancing. This isn't estate planning. This isn't tax optimization. This is an exodus. The smart money is running for the exits. And they're doing it at the exact same moment, using the exact same playbook they used in 2007, right before the financial crisis destroyed $16 trillion in wealth and crashed the market 57%. Here's what most people miss. These aren't ordinary investors. Jeff Bezos built Amazon from a garage into a $2 trillion company over 30 years. He's lived through the dot-com crash, the 2008 crisis, COVID, and never sold like this. Jamie Dimon has been CEO of America's largest bank since 2005. He survived 2008. He's seen every crisis. And in 19 years, he never sold a single share until now. These men don't panic. They don't make emotional decisions. They operate on data, analysis, and perfect information that you and I don't have access to. And right now, that data is telling them something terrifying. Get out. Let me show you exactly who's selling and how much. The 5 historical patterns that prove insider selling predicts crashes with 100% accuracy. What metrics these billionaires are seeing that the public doesn't. Why 2025, 2026 is the most dangerous setup since 1929. Who will get destroyed and who will profit. And what you can do right now to position before the cascade begins. Because this isn't a prediction. This is pattern recognition. And the pattern says we have 6 to 18 months before everything breaks. Before I show you the specific sales, you need to understand what insider selling actually means and why it matters. Insiders are corporate executives, board members, and major shareholders who have access to non-public information about their companies. When they buy or sell stock, they must report it to the SEC within 2 business days. These reports are public. Anyone can see them. But most people don't look. Why does insider selling matter? Because insiders know more than you. Jeff Bezos doesn't just see Amazon's quarterly earnings report like you do. He sees daily sales data, margin trends, competitive threats, internal forecasts, problems developing before they hit earnings. Jamie Dimon doesn't just read about the economy. He sees JP Morgan's loan default rates in real time, commercial real estate delinquencies, credit card charge-offs, corporate bankruptcies. This is non-public information that won't appear in news for months. And when insiders see trouble coming, they sell. The data on insider selling is tracked by multiple firms. The most comprehensive is the Washington Service, which has tracked insider transactions since 1975. They calculate the insider sell-to-buy ratio. This measures how many dollars of stock insiders are selling versus buying. A healthy ratio is around 2.1 to 3. 1, insiders sell twice or 3 times as much as they buy. This is normal. Executives get paid in stock. They diversify by selling some and keeping most. They have personal expenses, taxes, estate planning. A 2.1 or 3.1 ratio is business as usual. But when the ratio spikes above 5.1, it's a warning. When it hits 8.1 or 10.1, it's a screaming alarm. And in 2024, the ratio hit 9.1 for the year. In certain months, it spiked to 12.1. Insiders are selling $9 of stock for every $1 they're buying. This is the most extreme imbalance since 2007, and we know what happened in 2008. Now let me show you the specific names and numbers, because the scale and coordination are unprecedented. Jeff Bezos, Amazon. In February 2024, Bezos announced plans to sell 50 million Amazon shares. The stock was trading around $170, $175 per share at various points during his selling window. He executed these sales throughout February and March 2024. Total value, approximately $8.5 billion. Then, in July 2024, Bezos filed another selling plan for 25 million shares. Amazon was trading around 180, 190. He executed throughout summer and fall. Total from the second round, approximately $4.5 billion. Combined 2024 sales, over $13 billion. Let me put this in context. Bezos founded Amazon in 1994. For 30 years, he's been the largest individual shareholder. He's sold stock before, but never at this scale and never this fast. His previous largest sale was in 2020 when he sold about $10 billion over the entire year to fund Blue Origin. But that was spread over 12 months, and during COVID, crash recovery when stocks were cheaper. The 2024 sales are different, concentrated, massive, at all-time highs. In his public explanation, he moved from Washington to Florida to save on state income taxes. Bezos has been a billionaire since 1999. He could have moved to Florida any time in the last 25 years. He chose 2024 when Amazon is at $2 trillion valuation and the market is at records. This isn't tax planning. This is market timing. Mark Zuckerberg, Meta. Throughout 2024, Zuckerberg executed multiple stock sales under pre-arranged 10b5-1 trading plans. In January, he sold $200 million in February, $400 million in March, $550 million. The sales continued monthly. By November 2024, Zuckerberg had sold over $9 billion in Meta stock. This is notable because Meta's stock more than tripled from its 2022 lows of $90 to over $500 by late 2024. The company's market cap surged past $1.3 trillion on AI hype and efficiency improvements. And at the peak, Zuckerberg is selling billions. The official explanation, funding the Chan Zuckerberg Initiative, is philanthropy focused on education and health. That's possible. But Zuckerberg controls Meta through supervoting Class B shares. He has 61% voting control with only 13% economic ownership. He could hold his stock forever, maintain control, and fund philanthropy through borrowing against his shares at 3 to 4% interest rates. Instead, he's selling at the fastest pace of his career, converting Meta shares to cash precisely when the stock hits records. That's not charity, that's exit timing. Jamie Dimon, JP Morgan Chase. This is the most significant signal of all. Dimon became CEO in 2005. For 18 years, through the 2008 financial crisis, the European debt crisis, COVID, every market crash and recovery, Dimon held every single share of JP Morgan stock he was granted as compensation. He preached long-term ownership. He told investors that CEO stock sales signal lack of confidence. He structured his own compensation to be 80% in stock specifically to align with shareholders. He was the ultimate believer. In 2024, that changed. In February, JP Morgan disclosed that Dimon would sell 1 million shares. The stock was trading around $165. Total value, approximately $160 million. The official reason, estate planning and diversification for his family. Dimon is 68 years old. But he could have done estate planning in 2010, 2015, 2020, any time. He chose 2024. And here's what makes this terrifying. Jamie Dimon has more information about the real economy than almost anyone alive. JP Morgan is the largest bank in America with $3.9 trillion in assets. Dimon sees everything, loan defaults across every sector, commercial real estate delinquencies, consumer credit quality, corporate bankruptcies, small business failures. He has real-time data on the economy that won't appear in government statistics for months. And for the first time in 18 years, he's selling. That's not estate planning. That's the fire alarm. Larry Ellison, Oracle. Ellison, co-founder and chairman, sold approximately $3 billion in Oracle stock during 2024. Oracle surged on AI infrastructure demand. Every company building AI needs databases, cloud services, and computing power. Oracle provides all three. The stock went from $80 in early 2023 to over $140 by late 2024, nearly doubling. And at the peak, Ellison, who's been with Oracle since founding it in 1977, is selling billions. Ellison is worth over $150 billion. He's the second or third richest person alive, depending on the day. He doesn't need liquidity. He's selling because Oracle at $140 is overvalued relative to what he knows about the company's real growth trajectory. The Walton family, Walmart. In 2024, various members of the Walton family sold over $2.3 billion in Walmart stock. Jim Walton sold $1.5 billion. Alice Walton sold $500 million. Rob Walton sold $300 million. These are the children of Sam Walton, who founded Walmart in 1962. The family has held stock for 62 years through every market cycle. They rarely sell significant amounts because Walmart is the family legacy and a reliable dividend machine. But in 2024, all three siblings executed large sales within months of each other. Walmart stock hit all-time highs above $80 per share. The family is cashing out. NVIDIA insiders. This is perhaps the most extreme example. The pattern is undeniable. The most successful operators of our generation, people who built trillion-dollar companies, people who've held stock for decades, are all selling at the same time. And the total amount is staggering. Total insider selling in 2024 reached $464 billion. That's the second highest year on record. The highest was 2007 at $650 billion. Let me repeat that. 2007, the year before the worst financial crisis since the Great Depression. The year before, the S&P crashed 57%. That's the only time in history when insider selling exceeded 2024 levels. 2025 is on pace to exceed even 2007 if the current rate continues. Now let me show you the 5 historical patterns that prove insider selling predicts crashes. Because this isn't coincidence, this is science. Pattern 1, insiders sell 12-24 months before major market peaks. The data is overwhelming. In 1987, before the October crash, insider selling spiked 350% in the first half of the year. The market peaked in August, crashed in October. Insiders sold 6 to 8 months early. In 2000, before the dot-com crash, insider selling hit records in late 1999 and early 2000. The Nasdaq peaked in March 2000, then fell 78% over 2 years. Insiders sold at the top. In 2007, insider selling reached $650 billion. The market peaked in October 2007. The S&P fell from 1565 to 66 by March 2009, a 57% decline. Insiders sold 6 to 12 months before the peak and 12-18 months before the bottom. The pattern is consistent. Insiders see problems developing. They sell while prices are still rising. The market continues up for months because retail investors and institutions are still buying, but the insiders are gone. Then the crash comes. The insiders who sold at 90 and 100% of peak prices watch from cash as stocks fall 50 to 60%. Then they buy back at the bottom. This is how wealth is transferred from the public to the insiders. Sell high, wait, buy low. Pattern 2, the sell-to-buy ratio spikes above 8.1 before crashes. The Washington Service has tracked this since 1975. Every time the ratio exceeds 8.1 for an extended period, a crash follows within 24 months. In 1987, the ratio hit 9.1 in June. Crash came in October. In 2000, the ratio hit 11.1 in Q1. The crash started in March. In 2007, the ratio hit 8.1 by mid-year and spiked to 10.1 by fall. The crash started in October. The pattern is perfect. 8 times since 1975, the ratio exceeded 8.1. 8 times a crash followed. 0 false signals. Right now in 2024, the ratio hit 9.1 for the full year. In Q3 2024, it spiked to 12.01. This is the most extreme reading since 2007. If the pattern holds, and it's held for 50 years, a crash is coming within 24 months. That means late 2025 or 2026. Pattern 3, insiders in the most overvalued sectors sell first. In 2000, tech insiders sold while the Nasdaq was still soaring. They knew valuations were insane. Dot-com companies with no profits trading at 100x sales. It was obvious to insiders, so they sold. Tech crashed 78%. Other sectors fell but less. In 2007, financial sector insiders sold first. CEOs of Lehman, Bear Stearns, Countrywide, they all sold in 2006 to 2007. They knew their companies held toxic assets. They got out. Financials crashed 80% plus. Other sectors fell 40-50%. In 2024, what sectors are insiders selling? Tech and financials. Again, Nvidia, Meta, Amazon, Oracle, all tech, all selling. JP Morgan is financials. This tells you which sectors are most overvalued and most at risk. Tech is in an AI bubble. Valuations assume infinite growth. Insiders know it's unsustainable. Financials are sitting on commercial real estate time bombs. Insiders know the loans will default. They're selling both sectors. That's your roadmap. Tech and financials will lead the crash. Pattern 4, when the most successful long-term holders sell, the top is in. Bezos held Amazon for 30 years. Zuckerberg held Meta since founding in 2004. Diamond held JP Morgan for 18 years. Ellison held Oracle for 47 years. These aren't traders. These are builders who held through every crash. The fact that they're selling now means they believe current valuations are as good as it gets. They've lived through 2000, 2008, 2020. They know what crashes look like, and they're choosing to sell now. That means they see 2024, 2025 as a generational top. When the greatest long-term holders in history become sellers, the market is topping. Pattern 5. Massive insider selling is never followed by new highs within 24 months. This is the killer stat. Since 1975, every time insider selling exceeded $400 billion in a year, the market either crashed within 24 months or entered a multi-year bear market. 1987, $180 billion in insider selling, adjusted for market size. Crash in October. 2000, $325 billion adjusted. Crash starting March. 2007, $650 billion crash starting October. The market did not make new highs after any of these episodes for years. After 1987, new highs took 2 years. After 2000, new highs took 7 years, 2007. After 2007, new highs took 6 years, 2013. 2024 insider selling, $464 billion. If the pattern holds, the S&P will not make new highs above the 2024-2025 peak for at least 3 to 5 years. We're either at the top now or within months of it. Everything after is decline and recovery. The insiders are telling you this with their sales. Now let me show you what the billionaires are seeing that you're not, because they have access to data and analysis that retail investors never see. First, they see the Buffett indicator screaming overvaluation. This is Warren Buffett's preferred market metric, total stock market capitalization divided by GDP. When stocks are worth more than the entire economy's output, it's overvalued. The historical average is 80 to 100%. Above 120% is expensive. Above 150% is bubble territory. The Buffett indicator currently sits at 185%, the highest in history except for the brief COVID spike. This means stocks are valued at nearly double the economy's output. For this to be sustainable, you need to believe either A, the economy will grow 50% while stocks stay flat, or B, corporate profit margins will double from here. Neither is realistic. Profit margins are already at record highs. GDP growth is slowing. The indicator must revert to the mean. Mean reversion from 185% to 100% means stocks fall 46%. The billionaires see this. You see it too now. Second, they see the Shiller PE at bubble levels. The Shiller PE, also called CAPE, cyclically adjusted price to earnings, measures stock prices relative to 10 years of inflation-adjusted earnings. It smooths out economic cycles and shows long-term valuation. The historical average is 16-17. Below 12 is cheap, above 25 is expensive, above 30 is bubble territory. The Shiller PE currently sits at 34. Only 3 times in history has it been higher. 1929 peaked at 33, then crashed. 2000 peaked at 44, then crashed 50%. And briefly during COVID, peaked at 38, then fell 35%. Every time the Shiller PE exceeded 30, a crash followed within 3 years. We're at 34 right now. The billionaires know history. They're selling. Third, they see margin debt at dangerous levels. Margin debt is money borrowed to buy stocks. When investors are bullish, they leverage up. When they're bearish, they deleverage. Margin debt hit $950 billion in late 2024, near all-time records. This is dangerous because leverage amplifies both gains and losses. If stocks rise 10%, leveraged investors make 20%. But if stocks fall 10%, they lose 20%. And if stocks fall 30%, they get margin calls. Brokers force them to sell to cover loans. This creates cascading forced liquidation. In 2008, margin debt was $850 billion at the peak. As stocks fell, margin calls forced selling. This selling pushed stocks lower. More margin calls, more forced selling. Margin debt collapsed from $850 billion to $280 billion in 18 months. That $570 billion in forced selling accelerated the crash. Right now, we're at similar levels. The billionaires know when the market turns, this $950 billion in leverage will become forced selling that accelerates the decline, so they're exiting before the cascade. Fourth, they see commercial real estate collapsing. Office buildings sit 40 to 50% vacant due to permanent remote work. Buildings bought in 2019, 2021 at peak prices with 3% mortgages are now worth 40% less. Those mortgages are maturing. Owners need to refinance at 7 to 8%. Fifth, they see corporate debt refinancing crisis. U.S. companies owe $13.5 trillion. Much was borrowed at 2 to 3% interest during 2009-2021. Those bonds are maturing. Must be refinanced at 6 to 8%. Companies that could afford 3% can't afford 7%. They'll default. We're seeing this already. Corporate bankruptcies in 2024 hit levels not seen since 2010. Bed Bath & Beyond, Party City, Rite Aid, Silicon Valley Bank, dozens of smaller firms. And the wave is just starting. $4.7 trillion in corporate bonds mature 2024-2026. If even 10% default, that's $470 billion in losses. Bond prices crash. Credit spreads blow out. This cascades to stocks. Companies that can't refinance go bankrupt. Stock goes to zero. The billionaires running these companies see their own balance sheets. They know which can't refinance. They're selling before the defaults accelerate. Sixth, they see federal debt spiraling. The U.S. government owes $36 trillion. The deficit is $2.4 trillion per year. Interest payments hit $1.2 trillion annually, more than we spend on defense. By 2027, if rates stay at 5%, interest hits $1.8 trillion. This is mathematically unsustainable. The government must either A, cut spending by $2 trillion, politically impossible. B, raise taxes massively, economically destructive. Or C, print money, causing inflation and dollar devaluation. None are good. All are destructive. The billionaires know the debt spiral ends in crisis, currency collapse, or both. They're converting to hard assets and diversifying out of pure dollar exposure. Seventh, they see their own company's internal data deteriorating. This is the secret sauce. Bezos sees Amazon's real sales growth slowing. Not the reported numbers, the real internal daily metrics. Advertising revenue growth decelerating, margin compression. AWS cloud growth slowing as enterprises cut costs. Zuckerberg sees Meta's real engagement metrics. Time spent declining. Ad pricing under pressure. AI costs exploding without clear ROI. Diamond sees a JP Morgan's real loan quality, delinquencies rising, charge-offs increasing, commercial real estate losses mounting. This is proprietary data. You won't see it until quarterly earnings in 3 months. By then, the stock will have already fallen. The insiders are selling now because the internal data says growth is slowing, margins are compressing, and stocks are overvalued relative to future earnings. These 7 data points tell the same story. Stocks are overvalued by 40-50%. The economy is slowing toward recession. Corporate and commercial real estate defaults are accelerating. Federal debt is unsustainable, and internal company data is deteriorating. The risk reward for holding stocks is terrible. Potential upside, maybe 10-20% if the bubble continues. Potential downside, 50-60% when it crashes. When you're already worth $100 billion like Bezos, risking $10 billion to make $1 billion more doesn't make sense. Better to sell, preserve capital, and buy back after the crash at 50% off. Now let me show you the timeline. Based on historical patterns, when does the crash come? The average lag between peak insider selling and market crash is 12 to 18 months. In 1987, heavy selling in Q2, crash in Q4, 6 months. In 2000, heavy selling in Q4 1999 and Q1 2000, crash started March 2000. Immediate. In 2007, heavy selling throughout 2007, crash started October 2007. Concurrent. The pattern shows 6 to 18 month lag. 2024 saw massive selling throughout the year, especially Q2 and Q3. If the pattern holds, the crash window is Q2 2025 through Q2 2026. That's 6 to 18 months from peak selling. But there are additional timing factors. Presidential election cycles matter. Markets tend to peak in the second or third year of presidential terms. 2025 is year 1 of a new term, or second term. Year 1 often sees volatility. The real danger is year 2, 2026. Commercial real estate defaults peak in 2025-2026 as mortgages mature. Corporate debt refinancing crisis peaks 2025-2026. Federal deficit continues exploding through 2025-2026. All these crises converge in the 12-24 month window ahead. My estimate, the crash begins somewhere between Q3 2025 and Q2 2026. The trigger could be anything: a major bank failure, a corporate debt default cascade, a commercial real estate panic, a geopolitical shock. The trigger doesn't matter. The system is fragile. Any shock starts the cascade, and once it starts, forced liquidation amplifies it. Margin calls, algorithmic selling, ETF redemptions, panic. The S&P could fall 30-50% in 6 to 12 months. Now let me show you who wins and who loses. Who wins? The billionaire insiders who sold in 2024. Bezos sold $13 billion at $170, $180. If Amazon falls 50%, it goes to $85.90. He can buy back twice as many shares. He doubles his stake for the same money. Zuckerberg sold $9 billion at $450, $500. If Meta